A very good afternoon, good evening, and good morning to all our participants from different countries across the globe. My name is Happy Pant from the Center for Budget and Governance Accountability, New Delhi, CBGA in short. On behalf of CBGA, I would like to extend a very warm welcome to all of you to today's webinar on Global Minimum Corporate Tax, Looking Beyond the Surface. In today's program, we'll try and unpack the layers beneath the surface of the global minimum corporate tax deal from the perspective of the countries in the global south. But before we begin the discussion, I would like to give a very brief introduction about CBGA and the Financial Transparency Coalition, FTC. CBGA is an independent non-profit organization enhancing transparency and accountability in governance through rigorous analysis of policies and budgets, and fostering people's participation in public policy processes by demystifying them. CBGA is also a member on the coordination committee of the FTC. FTC is a global network of civil society organizations, experts, and governments that uses its wide reach and influence to have an influence on the global norms and standards for financial transparency and close loopholes in the global financial system. So today's webinar is an opportunity to consider whether this deal really has anything for the global south or the emerging economies or the developing countries. For discussing these issues, we have an expert panel with us consisting of leading economists, civil society leaders, and tax justice experts from the countries of the global south. My colleague Sarah Faruqi from CBG will be moderating this discussion. So I'll stop now and I'll hand over the mic to Sarah. Thank you.
I'll start with the session now. So just giving a brief context setting on the topic that we're going to be discussing today. So conversations around the global minimum corporate tax rate have been in the works for years. There have been multiple rounds of discussions about the needs and purpose of this tax and what the ideal rate of taxation itself should be. However, it was in the G7 meeting in London in early June and the G20 meeting in Venice in early July that a total of 130 out of 139 countries and jurisdictions engaged in these negotiations joined the statement. The global minimum corporate tax rate works under two pillars, aiming to ensure that large multinational enterprises pay tax where they operate and earn their profits. It also requires countries to impose a minimum corporate tax rate of 15% on multinational companies registered and recording profits in their jurisdiction. A small number of countries and jurisdictions that has not joined this statement includes Nigeria, Kenya, and Sri Lanka, among others. Initially, large developing economies such as India and China had also been skeptical, but eventually they supported this deal. The finance ministry in India said some significant issues, including share of profit allocation and the scope of subject to tax rules, are yet to be addressed, and a consensus agreement is expected by October after working out the technical details of the proposal. Now, one could argue that if multinational companies across the world are made to pay a minimum of 15% tax in their country of operation, it should be considered a positive move in revenue generation as well as in removing the use of tax havens. However, this proposal has met with criticisms from leading academicians, tax justice activists, and CSOs from across countries of the global south. The primary argument that props up is that the floor of the proposed common minimum corporate tax is considered far below the average global corporate tax rate of 25%. There are concerns that it would trigger a race to the minimum and will have countries seeking to match tax rates elsewhere for the fear of driving foreign investors away. Given the fact that countries are reeling from the aftermath of the pandemic and all COVID recovery efforts require revenue generation and spending, these concerns are only further exacerbated for countries across the global south. Many experts have also pointed out the complexities of implementing this deal uniformly, which are yet to be finalized and which require deep and contextual thinking. There are significant issues based on principles as well, and the primary being that the obvious concerns of developing countries which were ignored through the negotiation rounds of this deal. Since there is time to finalize this deal, as the details, the design, and the implementation will be finalized in October, there is an urgent need to have conversations that dissect this deal, that explain what it means for the Global South, and also what are the best ways to move forward. So with this backdrop, let me introduce our stellar panel today. So we have with us Chennai Mukumba. Chennai is a policy research and advocacy manager at the Tax Justice Network Africa. She is responsible for leading the policy unit and coordinating the institution's research and policy engagement at regional and global levels. She also oversees the institution's technical backstopping of TJNA's national level advocacy. Most recently, Chennai was elected to sit on the board of ATAF's African Tax in Women Network as the vice chair. We also have Professor C.P. Chandrasekhar, who is a distinguished and extraordinarily prolific economist. He taught economics at the Center of Economic Studies and Planning, Jawaharlal Nehru University, New Delhi. Besides JNU, he has taught at the Center for Development Studies, Trivandrum, and the School of Oriental and African Studies, University of London. His areas of interest include the role of finance and industry in development and the experience with fiscal, financial, and industrial policy reforms in developing countries. He's also the member of the Executive Committee of the International Development Economics Associate, an international network of economists engaged in the promotion of teaching and research using heterodox approaches to economic issues. We have Dr. Famida Khatoon, who is the Executive Director of the Center for Policy Dialogue, CPD. She holds a Master's in Economics from Jahangirnagar University, Bangladesh, and a Master's in Environmental and Natural Resource Economics, and a PhD in Economics from the University College London, UK. She did her postdoctoral research at the Earth Institute, Columbia University, USA, as a Fulbright Scholar in 2015. She was a visiting fellow at the Christian Michelsen Institute, Norway, Korea Institute for Industrial Economics and Trade, South Korea, and the Center for Study of Science, Technology, and Policy, India. We also have Liddy Nakpal. Liddy is a coordinator at the Asian People's Movement on Debt and Development. She's an activist working on economic, environmental, social, and gender justice issues in national, regional, and global campaigns. Liddy is the coordinator of the Asian People's Movement on Debt and Development and a member of the coordinating team of the Global Campaign to Demand Climate Justice. She's the convener of the Asian Energy Network and vice president of the Freedom from Debt Coalition. She has also served in the coordinating committee of the Global Alliance for Tax Justice and Financial Transparency Coalition. So with that panel, we're now going to start today's discussion with opening remarks from each of our panelists. So I'll start with Professor C.P. Chandrasekhar. So, sir, there are some significant questions around this deal that need to be probed. What does this deal mean overall for low-income developing countries? And also initially, India was against this deal and later it joined in. So what is the meaning of India's ambivalence? And also what is, even if you look at China's ambivalence also, what does that mean for this tax deal? And also if you can touch upon how this deal relates to the dominance of the financial capital and the neoliberal project, among other things. So I will share the floor with you and you can begin.
Thanks for that generous introduction and for inviting me to be a part of this distinguished panel and this event today. Quickly, to start with, I think it's useful to try and understand elements of the political economy of why exactly suddenly we are confronted with a situation where we have a half-resolved sort of platform which has been provided on an issue which is concerned the international community in all its forms for now, almost a decade. If you look at it from the point of view of the OECD process per se. And the first, of course, is that we have to recognize that in some sense, these discussions which have been occurring have been in a forum which was actually instituted in some sense by the industrial countries. It wasn't in an intergovernmental forum of the kind that developing countries, for example, were requiring of the United Nations to establish and make that the forum for discussion. As opposed to that, we had the OECD and G20 creating this inclusive framework where developing countries were invited to the table to express their opinions and join the effort at trying to get to some kind of alignment of international corporate taxation. So that's the first, that you, in some sense, shifted the location in which the principal discussions were happening to one in which the influence, however silent or invisible or at least opaque, of the developed countries would be quite significant, and the role of the OECD Secretariat would also be quite significant. So that's the first thing, that this discussion, in some sense, was moved to an environment in which the countries which are the parent countries for most of the transnationals who could get affected by this kind of a taxation regime aimed at extracting surpluses for a global development effort, with many aspects in now climate and post-COVID and so on and so forth. The second is that while these discussions have been going on for a very long period of time, the decision post the coming of the Biden administration to try and mobilize resources domestically to undertake investment, not merely in some kind of an infrastructural plan, but to push expenditures on education and health as part of an effort to generate a new kind of competitiveness against what they are perceiving as their principal enemy or competitor, whatever you want to call it, China. That their decision, of course, it was going to be more than 21% as far as they were concerned, but their decision to say that we should at least have a 21% floor, which all countries on a country by country basis agree to in terms of imposition of corporate tax, so that we would be in a position to be able to tax companies which are headquartered in our jurisdiction without them relocating their headquarters or resorting to tax shifting of various kinds. That seems to have accelerated the process by which we moved to this kind of a sort of quasi conclusion of the discussions which have been going on for a long period of time. It's in that context that I would place your question: why exactly did India or many other countries which had hesitation, agree in the final analysis to what is still an unclear package in terms of its complete components or its full components? But at least there is an agreement which is pushing them to sort of accept something by the time they get to October. The second is an interesting feature, is that the transnational firms per se don't seem to be particularly perturbed. So obviously, now the way in which that is being justified is merely to suggest that the reason they are not perturbed is because they would prefer clarity and a certain degree of stability of the tax regime, which they expect to come without having competition between nations, and that therefore they see in this some kind of a framework which is going to introduce a degree of clarity and stability of the global tax regime, is why they're supporting it. But obviously, transnationals are not just going to support a tax regime for its stability and its clarity. They're also going to support it if they think that it isn't, from their perspective, extortionary in terms of taking away significant share of the surpluses they sort of generate in global jurisdictions. Now, besides this political economy, which I think, therefore, in some sense, suggests that both the pressures of the OECD in general, the United States in particular, and the interests of the transnational firms explain to a certain extent the rapid movement between the coming of the Biden administration and this sort of partial, but not more than half, I would say, but a partial agreement on the package is important. Now, it's seen in that context, in some sense, the disappointment of a community which has been campaigning for a unitary tax of transnationals for a long period of time is understandable. And many points have been expressed. Since I'm the first speaker, I think these are known, but I'll just summarize it. One, of course, is the 15% itself. While it is true that having any minimum corporate tax is going to, in some sense, sort of stymie the sort of race to the bottom which we've been seeing over a long period of time. Setting that at 15% essentially means that we're going to have a race to the minimum. Countries which were taxing higher, that there's an average corporate tax of about 25% globally is what some people say, that you're actually going to see a race to the minimum. as all countries move to 15%, which is going to be nearly 2.5%, let us say, above what Ireland, which is considered a sort of tax haven to which Apple and so on went and located themselves for major tax benefits, imposes. So you really have gone to a relatively low level. The second, of course, is that that this has come with a kind of conditionality which developing countries or emerging markets seem to have accepted, not just emerging markets, but even developed countries. That is, countries that had already begun a process, and 6 of them have already been challenged by the United States, and including India, to say that, listen, since post-digitalization, there have been transnational firms without a commercial presence in these countries that is operating in their jurisdictions, are earning revenues and a significant share of their profits from there, that they should have a right to tax this as much as countries which are hosts to the parents of transnational firms see themselves as having a right to tax their firms. And therefore, we had a digital services tax, which many countries, including countries like France, but other countries, Italy, Austria, etc., and had imposed, and so had India. And what you're actually saying is that as part of Pillar 1, you're going to give up, or you're required to give up, you implicitly agreed that you're going to give up this digital services tax in return for what seems to be an extremely unclear and definitely high, substantially reduced, tax share or share in taxing rights, which are going to be relocated to these countries. And that's because of the fact that what you're basically saying is that we're not going to look at it in terms of revenue source or profit source from particular jurisdictions. You're basically going to say that if there is a transnational which is operating in these countries, we will, on the basis of some formula, which of course is unclear still, assume that so long as they are earning at least euro 20 billion, or let's say that they're large firms, that anything about 10% you can tax. That is, you exclude 10% of their profits, and you can tax. Well, they say 20 to 30%. It's most people say 20%. But even whatever it is, you're basically saying that you're giving a residual right, a right to residually tax a share of profits post a certain sum of a limited number of entities, which is basically saying that there seems to be an agreement which has been in sort of arrived at, in which, without all the details being put down, the sort of the presentation is one in which it's being suggested that countries have given up their effort to try and retain a right to determine their own tax rights on the basis of the sourcing of profits and revenues and profits, and really accepted this formula, which of course is still not completely clear. So it's not only that you actually have a minimum tax which is low, but Pillar 1 is going to be one which is going to deprive countries which earlier were trying to move into this arena in order to be able to get a certain. Finally, I think if you put all of this together, and if you take into consideration the carve-outs, we're still not sure what all are the carve-outs. There's a carve-out for finance. There's a carve-out for shipping. There's there's going to be a carve-out supposedly to please India and China, where taxes which are or things which are done in order to be able to attract investment in physical, factories and equipment, etc., would be allowed to be carved out, etc. There are many kinds of exceptions, and of course the natural resources sector. So, I mean, there's huge set of carve-outs which are going to come, and we don't know at the end of that what's going to be. There are estimates floating around of what's going to be the amount available. So altogether, to summarize, one is that this has been an enforced deal within a framework which fundamentally was iniquitous. That iniquity is reflected in the outcome in terms of the level of taxation of transnationals, because it is biased in favor of the transnationals. It is biased in favor of jurisdictions which are the parent countries for these transnationals. And it actually is depriving countries of the potential of a significant share of taxing rights, so that both in terms of the overall requirements of a resilient recovery, which is global, and in terms of the need to overcome international inequality, it's not at all surprising that this process, given its political economy and the outcomes, is being seen as extremely disappointing relative to the demands which the tax justice community has been putting forth. I think I'll stop there.
Thank you so much. I think you really carved out and explained, how the discussion was moved, the role of the Biden government, the interests of the transnational firms, the carve-outs, and these are very important points which I feel often do get buried in the bigger pillar one, pillar two, what those actually are. So we'll come back to some of this in the question and answer round. At this point, I want to bring in also Dr. Famida Khatun. So the questions that I want to ask you is that as a developing country, how does Bangladesh view this deal? And what does it mean overall for other low income, for developing countries? That do you feel that some important issues have been neglected or pushed under the carpet? And also, one of the main questions that we've been hearing a lot of tax justice activists, a lot of people also question is that in a post-COVID world, can and should the decisions of Western countries be implemented uniformly across countries of the global South, each of which has a different context and population? So over to you.
Thank you very much, Ms. Sarah. And I'd like to thank CBGA for inviting me. So I'm really honored and humbled. I would just straightforward will go to your question. You see, countries like Bangladesh, which is at this moment, it is a least developed country, so LDC, and it's going to be graduating by 2026. But Bangladesh and similar countries, they have a unique, challenge. The challenge is that on the one hand, there is limited domestic resource mobilization effort, and secondly, they have competing priorities. So domestic resource mobilization has become a key challenge for taking forward the development initiatives of these countries. And in fact, so Bangladesh has been, sadly, that it has been showing very low performance in case of revenue generation. Tax GDP ratio is about 8%, which is really low compared to the South Asian countries. So in this respect, you see, one of the major sources of taxes is the corporate income tax, and so from that point of view, this global tax rate, global corporate tax rate is going to be, having an impact, significant impact. I would say that this global minimum corporate tax deal, because on average, though this deal says about minimum tax of 15%, but countries like Bangladesh, the average tax, corporate tax is 30%. It varies actually for the listed companies and also for the non-listed companies, but average is that. So as I have mentioned that this is one of the major sources of corporate taxation effort. So now, so I, as from the Bangladesh's point of view, I would say that this type of global rates should not be applied, across the board. And each country has its own problems, own structures, own behaviors, and also the whole institutional pattern. And here, one size fits all, this measure is not going to help these countries. Rather, and also for Bangladesh, each country has, each country has its own distinctive issues. And once you are bound by this global regime, then if certain issues come up next year, for example, how to deal with that. So getting locked into one such global institutional arrangement or global rules and regulations is not going to help in a way, because how much leverage it would give. And also, as my previous speakers mentioned, that the whole political economy context is totally different from the perspective of the southern countries. And also, Bangladesh is going to be graduating, by 2026, and after, that after graduation, there are, among many challenges, resource mobilization is going to be a big challenge, because the foreign aid support from the multilateral organizations, and even from countries bilaterally, the grant or support at a very low cost, those will be gone, and the country will have to mobilize resources at international rate from the international market at a commercial rate. So and on the other hand, the demand, since these countries are emerging, and the demand for growing faster is also there. Pressure for more employment generation and for more investment is also there. Now, one argument which is applied here in this case, also by previous speakers also mentioned, so it is the attractiveness of the foreign investment, that whether at this level, at a certain level which is not very competitive, whether the foreign investors will be attracted. But I would say that there have been many studies that corporate tax or taxation is just only one measure. It depends on many other factors, the bureaucratic complexities, red tapeism, good governance, rule of law, transparency, skilled manpower, infrastructural facilities. All these also play a role in attracting foreign investment, and also the whole governance issues, the technological penetration and adoption, that's also very important. So I would say that this is not at this point in time for countries like Bangladesh, it is not a very very healthy or something which would really help Bangladesh. And your last bit, particularly more so in a period when we are struggling with the fallouts of the COVID-19 pandemic, and the recovery would require huge investment, huge government investment, basically to also support not only the poorer or marginalized people, but also businesses, big, small, medium, each and everyone. So when the country needs more resources to recover, and also not only recover, but globally we are also hearing that we want to build back better. So you recover in a way which is smooth and sustainable. So if we think of those that higher resources, how would we generate resources? That would be very important. Also, I want to add, along with the COVID-19 pandemic, the issues of climate change. For Bangladesh, it is a really very big challenge, how to tackle that challenge. And also, there again, we are seeing international commitment for addressing the challenges of climate change is not very promising. We see for Bangladesh, it is the country which is at the receiving end. It is not a big, emitter of carbon. However, it has the, it is suffering from that. So, but on the other hand, you see, if you look at the distribution of climate funds, mitigation funds always get higher allocation rather than adaptation, so which the poor countries need more. So that's why, of course, the global commitment has to be there. And of course, this deal is going to help streamlining and also bringing some sort of governance, which is going on, which we are observing that the whole tax regime, global tax regime, is suffering from so many shortages and predicaments, and as a result, we have seen so many tax havens are there, and the number of tax havens have actually increased, and they are using the loopholes of these taxation system. So of course this might help, but this is not something which the poor countries like Bangladesh and many other countries can really adopt to this, because it requires more resources, and it requires to recover from the fallouts of these challenges. Thank you very much. I would like to stop here.
Thank you, Dr. Khatun. I think you really fleshed out and explained this notion of why this, one size fits all will not, it's something that will not help and not apply to all countries. So at this point, I'd like to bring in Liddy to highlight her views on some of these questions. So, Liddy, can and should the decisions of, again, these decisions made by these Western countries, can they be implemented uniformly across countries of the global South? And how do you see the fairness of this deal? And again, what does this deal mean for developing countries? And, what are some of the important issues that are relevant and that you think have been neglected? And if you notice, like, this deal has been in discussion for years. Why is this particular moment, this particular time important, and why was it discussed and agreed upon now?
Yes, thank you. Thank you, Sarah. First, I'd like to say thank you for CBGA for inviting me. And it's really great to see a lot of familiar faces, especially to see Professor Chandrasekhar, who I haven't seen for a long time. Thank you for inviting all of us to speak here. Movements and civil society groups in the South and globally have long been calling for urgent changes in national and international tax systems as part, of course, of broader economic transformation. And a very crucial area of concern is precisely the taxation of corporations, especially multinational corporations. The recent tax proposals, and we should mention here, it is the OECD, the G20, and the G7, which represent the world's richest and largest economies in terms of GDP, and the emerging consensus among them are really deplorable, alarming, but yet not so surprising. These proposals favor corporations and the countries where they are headquartered and fail miserably to address the deep injustices and inequalities in the international tax architecture and the reprehensible tax and related practices and behaviors of corporations and the governments which basically take their side. So in this forum, we focus on two major issues. Of course, the first is the proposal for the unbelievably low rate of 15% for the global minimum corporate tax rate. This is far below the average corporate tax rate in all of Asia, which is already a low of just above 20%. And in Southeast Asia, it is only just above 23%. So 15% is even lower than these average rates. This proposed rate falls gravely short of the objective to raise revenues in countries of the South, as our previous speakers have already emphasized, or what we refer to as developing countries. The UN Economic Commission for Asia and the Pacific, or UNESCAP, in fact is saying that developing countries in Asia will need public investments amounting to at least $1.5 trillion every year to attain the Sustainable Development Goals for the 2030 Agenda. Comparing this with what the OECD proudly declares as $150 billion in annual additional revenues from the proposed rate of 15%, which is not all going even to the developing countries. This failure to meet financial need is not even the sole issue. Consider that when multinational corporations reap trillions of dollars of profits from the backs of workers in the South, from the plunder and extraction of natural resources in the South, from the huge ecological damage that they cause, disrupting the lives and livelihoods of communities in the South, and the huge contribution they make to the escalation of the climate crisis that impacts the peoples of the South the most. To reiterate what we have already repeatedly pointed out, and that our speakers also have pointed out, the proposed global corporate minimum tax rate of 15% sets a dangerous signal in a global race to the minimum. Several laws have been passed by governments in Asia since the beginning of the pandemic to further reduce baseline corporate income tax rates under the pretext of stimulating the economy, but in reality keeping pace with declining global and regional averages. The 15% proposal will only accelerate this process under intensified pressure from domestic and multinational business lobbies. By setting a global minimum precipitously close to nominal tax rates of tax havens, the OECD G7 G20 tax proposal triggers an unambiguous signal to the rest of the world that lowering corporate income tax rates to 15% is not only acceptable but will be the gold standard. The second issue is the proposed base and allocation of tax revenues from multinational corporations. The proposal involves setting a very high profit threshold and giving priority in allocation of revenues to countries where multinational corporations are headquartered. Hidden beneath a very complex technical facade is a deeply regressive arrangement. It covers only about the 100 biggest multinational corporations and their, quote, residual profit margins, unquote. The vast majority of NMCs who unjustly shift their profits out of southern or developing countries will be allowed to continue with business as usual. Furthermore, by privileging countries where MNCs are headquartered and the taxation of profit margins from sales, the proposal precludes the taxation on profits from employment and assets, which are central to value extraction of MNCs from the global south. It also creates an abstract and unrealistic separation between routine and residual profits, enabling multinational corporations to take advantage of loose regulations on transfer pricing for a lion's share of profits generated globally. This proposed allocation of tax revenues will serve the global north much more than the global south. Certainly, these are not the only issues and challenges in the international tax system. There are other factors that pave the way for illicit financial flows and unjust and unfair taxation, including weak transparency frameworks and regulatory mechanisms, very wide-ranging corporate tax incentives, tax havens, corruption, even outright fraud. And these occur within the largest inequity and imbalance in economic and political power across countries and between people and communities as against elites and corporations. Negotiations on global tax agreements have no place in the undemocratic and elite platforms of the G7, the G20, and the OECD. Rich country governments, legislative lobbies, and direct influence by multinational corporations are now aimed at expediting the ratification of these proposals by governments in order to forestall demands for higher global minimum tax rates and a just allocation of taxing rights. This underlines the urgent responsibility of civil society and governments in the global south to assert equal rights to decide on global tax rules in intergovernmental platform under the auspices of the United Nations. The multiple crises we are facing today and the COVID-19 pandemic, the economic crisis, the climate emergency, this present a historical opportunity to transform global corporate taxation and national tax systems. It is tragic that the solutions offered by the world's elite countries only serve to reinforce inequalities in the global tax regime that have long excluded the voices and interests of developing countries and peoples in the global south. We have long been bearing the horrific cost of social and economic and ecological flaws in our systems, in our economic systems, in our tax systems, and in our fiscal policies. As organizations, and this is to answer that question, as organizations and peoples committed for more equitable and just societies, we must reject these proposals. We call on other movements and civil society organizations to mount a strong resistance, and we must be loud and resolute and harness the force of collective action in this resistance. Thanks.
Thank you so much, Liddy. I think you highlighted and took us through almost quite a few reasons of why this deal will serve the global north over the south, and also you kind of underlined really emphatically the role of civil society organizations and also the government in this, and how the intersection of these different institutions have to kind of come together. So at this point, I want to request Chinay Mukamba to come in. Chinay, what are your views about some of these questions that we've been discussing on whether the decisions of the Western countries can be implemented across the countries of the global South? How do you see the fairness of this deal? And what does this deal overall mean for low-income countries, for developing countries? And again, what are some of the issues that you feel have been neglected that should have been highlighted and been more emphatically added? And again, on the timing of the deal, what would you have to say on that?
Thanks so much, Sarah. And thanks so much for inviting us to this platform. I'm really excited to be able to share some of the thoughts that us as TJNA have been having around this deal. So I think in response to your first question, in short, it's completely unfair. I don't think there's any way to try and even, explain how it is that it is treating both countries in the global north and the global south the same. And for me, what is most shocking, what is most striking is that it's not even trying to have a semblance of fairness. Because when you start to take a look at the details of what's being discussed, I think Prof mentioned that, there's a lot that still needs to be unpacked and explained. But what is already being revealed with regards to what will be, within this particular agreement, you can already see that global South countries are going to be disadvantaged. First of all, as has already been said by all of the previous speakers, the corporate income tax rate is incredibly low. In Africa, you have certain countries that have corporate income tax rates at about 35%. And it's shocking to see countries come to an agreement on a global minimum corporate income tax that they say is supposed to help promote domestic resource mobilization, but has a rate that's much closer to that of tax havens. And then to draw it even more specific to the African context, many African countries right now are dependent on regressive taxes, so value added tax and various other consumption taxes. And so what this potentially is going to do is push us much more in that direction. And of course, with regressive taxes, it's always to pick up what Liddy was talking about, the most vulnerable and the most marginalized who are most negatively affected by this. And so, when I was talking earlier about when you take a look at the fairness of this deal, right, you can see already the leaning towards preference for developed countries, right? Because essentially what's going to happen is if this 15% global minimum corporate income tax is implemented, right, we will have our tax authorities looking to see the extent to which different countries are imposing, various tax rates. And so what's been decided currently, right, is that if a country, for example, is giving something, is providing a tax rate that's lower than the 15%, what's called the income inclusion rule is what's going to kick in, right? So for example, let's say, because in many African countries, there's actually a case for, certain incentives to be put in place that are called cost-based incentives that are necessary in actually promoting economic development. So what you've done is you've said if an African country, for example, wants to put in place that kind of tax, let's say 7%, the income inclusion rule indicates that the difference between that 7% and that 15% will be sent to the residence country, right? Which is more often than not the developed countries, the global north. And it is shocking, right, that would be the primary sort of backup rule to a country that doesn't implement this 15% rule. And then after that, you then have sort of the secondary rule, which is the undertaxed payments rule, which benefits developing countries. And this one is being made secondary. So already you can see that in the implementation of what's already being proposed and put out, it's developing countries that end up losing. It's developing countries that essentially, like I said earlier, if you're implementing some of these rules, are getting the benefits, right, of these profits. And in response now, I think to your question about what does it mean, right, overall for low income or developing countries, it means we lose, right? We lose again, and then we implement a system that is potentially going to perpetuate, a global economic architecture that further disadvantages developing countries and further perpetuates inequality. I resonate so much with what Liddy was saying, and as well as the previous speakers about what the implications this could have on their countries, particularly in Asia. And I just want to reiterate that even on the African continent, this is the same thing, right? And so in response to your third question, what are some of the important issues that have been neglected and pushed under the carpet? I think Prof mentioned earlier that, there is a lack of legitimacy with regards to the countries, right, that are coming up with these rules. It makes no sense that, the ministers of finance of the 7 richest countries got together and said, these are the rules that we think should apply globally, right? There is a democratic deficiency within these institutions. Why? Because they are actually the beneficiaries of the current system and will be further beneficiaries of this new system, right? What we need is what one of the recommendations we see in the factory report, a global tax body, right? Where we each have equal footing and equal say in these conversations, right? Because right now what we're seeing is, the promotion of a system, right, that doesn't at its core have citizens as its primary interest. Prof was talking earlier about, what Pillar 1 is proposing, right? And what they're saying, Pillar 2 will then make up for, right? And basically the proposition here is, let's do away with digital services tax. I was watching CNN yesterday, and Amazon is reporting almost 100% profits, right? With almost $100 billion, right? And basically you are taking away the rights of developing countries to be able to tax that, right? Facebook, for example, all of these digital services companies are recording some of the highest profits that they have ever seen. And essentially, we're taking away the rights of developing countries to be able to draw taxes and essentially promote their domestic resource mobilization. And I mean, I'm not saying this on the record, but this is part of the reason why, we're of the view that, for example, Kenya didn't sign on this, right? Because already there's a quite a healthy digital services system within Kenya. But I think for me, as I wrap up, you're right to say that this discussion has been on the table for years, right? And your question is, what is the significance of the timing of this deal, right? Why is it particularly important that it's being discussed now? I think we need to acknowledge, right, that in as much as we've been talking about this, we started to see momentum in this conversation when the Biden administration came out and said, we'd like to start having a conversation about a 21% global minimum tax. And then all of a sudden we saw a lot of, people start to want to participate in this conversation, because even within the United States, right, because of COVID, we can see that they too are struggling with what almost every country is struggling right now, which is an incredibly situation where you've got high expenditures, right, because of the health and economic effects of COVID, but because of the decline in economic activity, insufficient revenues, right? And so they want to start to have a conversation around how they can promote domestic resource mobilization. And sadly, it's gone now from 21 to 15%. And so this is the reason why a conversation that's been so quiet has all of a sudden come to the fore, because of the situation that every single country. Now, it's interesting to me that America is facing this problem. I mean, this problem is much, much more exacerbated within developing countries, right? And not only that, because this is no news to anybody, but developing countries are also currently facing, this debt burden. So in addition to these two issues of insufficient revenues and high expenditures, we also have, this debt servicing. And so there's a need to figure out what policies can we start to put in place to increase our domestic resource mobilization? Unfortunately, what's being put on the table right now is not one that actually addresses the African context, and is not one that I think addresses, based off of what I've been hearing from the previous speakers, the global South context. And so I think for me, Sarah, I'm about to hand back to you. Those would be my perspectives. I mean, it's not only is it unfair, it's egregiously unfair. We had a webinar a couple of weeks ago where we had the African Tax Administration Forum, sit and share some of their thoughts. And, the executive secretary, his name is Mr. Logan Watt, expressed such frustration because he said that as ATAF, they, when these conversations had been happening, had submit proposals, to this conversation that said that they said they would need to see if it was to truly benefit African countries. None of those proposals were taken on board, and that speaks to just that lack of inclusivity, even though it's called, an inclusive framework and, is supposed to be benefiting all. I'll close off by saying a couple of weeks ago, just because it's so topical, I was sitting in a webinar with a colleague of mine who I think is actually watching, and, this conversation had come up, and, an American senator who was listening said, I have a question, I don't understand why there is so much backlash, from developing countries for something that we think is historical. And in response to her, we said it's historical in that, it's the first time in a long time that we have seen everybody, all countries come together and want to have this conversation. But it is completely unfair. And if we were to agree on this, which is what she was proposing, is we would lock ourselves into a system that would take years to undo and correct in order for it to benefit, developing countries. And so I just to end, I close off by what Dereje, who I think is the Executive Secretary of the Global Alliance for Tax Justice, said, no deal is better than a bad deal, because we would essentially lock ourselves into a system that would take years to unpack. So thanks, Sarah, for inviting us to this platform, and happy to answer any more questions that may come up.
Thanks so much, Chennai. I think you really unpacked, why this is an unfair deal, and the term democratic deficiency, that itself, you explained it extremely well, and you gave us a very good overview also of the African context. So I hope some of these points will also be touched upon in the questions. So we now open the floor for questions to all the panelists. So if you have any questions, feel free to pose it in the chat box. I think we have one question right now. Okay, so this is a question for all our panelists. Can this proposal be seen as a next frontier locking in the MNC digital businesses in practice will not be taxed, or very little going into the future? Or rephrased, are digital MNCs the actors benefiting most from this proposal? So this is a question for all our panelists. So I think, if we can start with Professor Chandrasekhar, if you would like to take this question, and then we can quickly go to the rest of our panelists. I can
take it, but since I started the presentations, maybe somebody else would like to respond, and then I can comment, but otherwise I can take it.
Sure. Liddy, would you like to go forward?
Maybe I can start, and then Professor Chandrasekhar can add and others can add. Yes, of course, the digital MNCs will be benefiting a lot from this proposal, but I don't want to undermine or underemphasize the fact that many MNCs will actually be benefiting from this proposal. I mentioned, of course, in the presentation that the thresholds being set in the first pillar, for the tax base as well as for reallocation of the taxing rights, that is what the first pillar is referring to, is actually setting it so high that so many MNCs will be benefiting because they will not be reaching that threshold. And for the minimum tax rate of 15%, as our speakers have also mentioned, and as I have also emphasized, in Asia, the current average is already low, we think, but 15% is even much lower. So that will also benefit many MNCs who are operating in Asia, which is the fastest growing region in the world. I believe in Africa, the average corporate tax rate is even higher. Chennai, right? It's, I think, above 25%, 28%, or 30%.
Yeah, in some countries, it's almost 35%.
Yes, exactly. So, yes, definitely we need to emphasize how digital businesses, not just in this proposal, but in many existing approaches to taxation, are really raking in a lot of profits because they are in gray areas which are not yet covered by tax policies. But certainly this proposal is going to benefit them.
Thanks, Liddy. Chennai, would you like to comment on this?
Yeah, absolutely. I think we definitely see the vested interests of large digital services, digital service companies. I think I mentioned earlier, it was just 2 days ago when I was seeing, the profits that are being raked in. It was Amazon, Facebook, Google. Amazon, raked in profits of $100 billion, just over this last annual year, 100% more than they had the year before. It makes no sense to me why you would want to exclude them, right, from being taxed, right? Exclude them from the different MNCs that domestic countries, right, where they have a number of their customers, are able to then draw domestic resources. And so for me, I definitely, I think I would say that those vested interests are very clear, particularly because they're based in the global north. And unlike, for example, some of the other sort of more tangible institutions we see, they don't actually have physical presence, right? So I would agree with Shelley that I think there is quite a lot of private vested interests that are being put forward. COVID, of course, has increased the amount of digital usage, right? And so it's heartbreaking to see that these institutions that have benefited from something that has ravaged the world seem to be getting away with even more. So I think for me, I would completely agree with that.
Well, we also have to see the context. It so happens that in the world, the dominance of finance, the principal, most profitable, and the ones which get the largest revenue happen to be the digital firms of different kinds, whether they be Silicon Valley firms or whether they firms which are e-commerce firms like Amazon and now Walmart and so on. It just so happens that in the choice of what activities to back, which finance makes in the current neoliberal dispensation, that this, which allows you to get reach to a large number of clients, customers, whatever it may be, these are the firms which are big. But I think we should also recognize that despite the fact that there is this leaning towards so-called tech firms, because and why is Uber a tech firm? It's just, why is Facebook a tech firm? Facebook is just a social media platform. It's not like the old notion of technology that we had. It's just that this is what finance makes technology. But if you look at it, the United States dominates. So it's not merely digital firms. It's the United States which is going to be the big beneficiary of keeping these digital revenues out of direct taxation and merely directing the sort of, as Lady put it, directing the sort of high threshold definition and low tax regime to the top 100 firms, so generally, not just the digital firms. So while all multinationals need to be taxed, the fact that you let the digitals off to a certain extent by getting rid of, or possibly getting rid of digital, is going to benefit the United States or multinationals from the United States much more. Yeah, thanks.
Thank you, Professor. Okay, there's a question from Shelley Bhasin, and this is again to all the panelists. Why have developing countries been mute and unresponsive in putting their terms on their global alliances in the history? I believe COVID has brought almost all the countries from global north and south on a level playing field, and this is an opportunity to begin equally and with equity. What are your thoughts? Dr. Khatoon, would you like to take this?
Yeah, this is a very relevant question, in fact. And situations like this really call for an alliance from the developing countries, in fact. In the past also, we have seen when we negotiate at the global platforms, there is some sort of lack of unity in though sometimes interests are common, but we see differentiated voices. But I think issues like these, which are going to have serious revenue implications and development implications for the developing countries, this is a time when we all should talk in one voice, and this is the moment to raise the voice. I really appreciate the question, which has been rightly posed by the audience. Thank you.
Thank you. We have a question from Vedant Nair to all the panelists. The OECD impact assessments show that for combined Pillar 1 and Pillar 2, low and middle income countries will increase their corporate tax revenues by 4 to 5%, which is about the same as high income countries. Is Pillar 1 and Pillar 2 unfair because low and middle income countries should receive proportionately more than high income countries, or because alternative proposals would benefit low and middle income countries more? And do you not believe the OECD numbers?
May I come in on this one, maybe just to start it off?
I saw your face and I was going to address it to you.
Yeah, well, this is the thing with statistics. 4 to 5% of the income from tax revenues of rich countries in nominal terms is much, much higher than what developed low income and middle income countries are getting. That's one. So you're talking about percentages, but when you're talking about actual amounts, it's much higher. Secondly, I haven't really scrutinized the details of the assessment of the OECD impact assessment, but I would like to see how they apply this individually for each country, how that bears out. Because I suspect the 4 to 5% is an aggregate total for all low and to middle income countries. I don't think the math adds up when I think that in many Asian countries, the average global corporate tax rate is higher, much higher than 15%. And how can that redound to a much higher benefit in terms of revenues if they're going to lower that to 15%? And just on that, just to add to that first question, I think one of the reasons why many Southern countries are not as aggressive in putting forward proposals, they themselves are caught up in this race to the bottom. They're buying into this myth that we need foreign investments. We need all these multinational corporations come to our countries to invest, to help our economies grow. And therefore, one of the things they do is really to provide tax incentives, which are going to undermine whatever corporate income tax minimum tax rate is going to be agreed on. So many tax incentives in order to attract these tax investments, these foreign investments, and it hasn't actually been proven that it has brought about the benefits, the so-called benefits. No, in fact, what we've seen is, a lot of our countries in the South in this race to the bottom have been lowering, for instance, labor costs, wages of labor in order to attract these foreign investments alongside with these tax incentives. So in any case, let's study this. How do they apply this country per country in terms of this so-called aggregate increase in revenues?
Thanks, Liddy. If I can get you in on this, Prof.
Yeah. No, I want to say, I haven't looked at this particular set of estimates, but first of all, if you want to make a Pillar 1 calculation, you should make a net calculation. It's not only what you're going to get out of the fact that now there's going to be a certain amount of residual profits depending upon your share in whatever, in in sales or whatever it is, it might be of the firms concerned, of the top firm concerned, you're going to get a residual profit which you can tax to the extent of, let's say, 20%. And it's not just that. It is what you're going to lose because of the fact that you're giving up your right to tax. Cross-border provision of digital services, which is the major component, which all countries, including France, which is actually objecting to this, has seen as a possibility. So I do think that this idea that there's going to be 4 to 5% is for both at the margin is I'm willing to accept that possibly developed countries are not going to lose very much, but because of the fact that they brought their tax rates down over a period of time. But to say that they're going to actually get only as much as developing countries, I think there's something there. I just want to go back to an earlier question on the fact that developing and developed countries are now post-COVID in a position of greater equality. I think the equality is only in the fact that the virus has been completely class neutral. Otherwise, if you look at it in terms of the response to the crisis, if you take what is the degree to which countries have had the ability to be able to undertake additional spending to meet the health emergency as well as address the economic crisis, you're talking about developed countries operating in ranges of 15-20% of their GDP being the additional expenditures, whereas you're talking about developing countries operating at something like anywhere between 2 to 5%. Okay, and even that 2 to 5% is because of the, not because of the fact that your additional spending has increased, it's because your GDP has fallen so much that your fiscal deficit to GDP ratio seems to be higher. It's not really. So if you look at it in terms of the ability to be able to deal with the crisis, this crisis has finally hurt the South, the developing countries, much more. And then you add on the fact that the developed countries have gone around buying all the vaccine in sight to the extent of many multiples of their populations. Then you're obviously saying their ability to be able to deal with the virus in the months and couple of years to come is going to be far better than that of the developing countries, which will have to go through many waves. So I do think this is a time of weakness for the developing countries, even though virus in some sense in terms of its effects, its infectious effects is more or less size or wealth or class neutral. Yeah. And even that not fully neutral, by the way. The poor got infected more.
Thank you. Chennai, would you want to add into this?
Yeah, I just had, first of all, this conversation is really interesting. Thank you so much, Sarah, for organizing it. I just had 3 comments. First of all, I completely agree with Prof. If he hadn't said it, I was going to say it. The pandemic, if anything, has exposed the inequality, right, both across and within countries, right? And I won't go into too much detail. I think that's been really well explained. But I think at the end of the day, this has not created a level playing field. I mean, all it's done is, like he said, indicated that we are all fragile and, essentially, we could all be hit by a virus, but like he said, our ability to respond and the effect on countries has been very different. I also just wanted to, I think, make a quick comment about, the 4 to 5%, I think, GDP increment. I mean, it's interesting because, for example, we do a lot of work around illicit financial flows and the negative impacts they have on domestic resource mobilization. And when you take a look at the figures, right, the countries that are actually losing the most, when you take a look at the numbers, are countries in the developed world, right? But the effect of those losses, right, even though developing countries are losing less, is much more significantly negative on poorer countries who've got smaller budgets, right? And so that's why we argue and make the case for a global system, right, that can address these issues. So 4 to 5%, right, for Lesotho is very different, right, for 4 to 5% for Switzerland, right? And so I think that's really important. And I think the point Professor made around the net outcome of this decision, I mean, I think he made a fantastic point as well around, removing digital service tax ultimately benefits America, right? So think through how, yes, for example, they may make a loss of this much, but how much are they going to gain, right, from their tech companies that are based there. And then I think I also just wanted to make a quick comment. I think Liddy made a really, really good comment about the fact that, as civil society, we are making the case for the fact that we need to have higher tax rates. But interestingly, you're starting to see countries, and even across the African continent, begin to lower their tax rates, right, in an effort to try and attract private investment. You almost understand it, right? Because like I said, they find themselves between a rock and a hard place. They need to increase the domestic resource mobilization. But in the long run, it is detrimental, right? Because you're doing away with your own ability to raise resources. But not only that, because of the race to the bottom now within your region, you're disadvantaging even your neighbors, right? So I think that's really important. And I think even us as TGNA have been trying to do some work, right, around particularly like international financial centers that are being established to do this, right, to indicate that this is not the best way to raise resources. Thanks, Sarah. Back to you.
Thanks so much, Chennai. We have a question from Matty to all the panelists. Which intergovernmental body or coalition could serve as a negotiation platform for an alternative proposal? Could UN regional agencies, G24, UN Office for South-South Cooperation, or could ATAF collaborate with other tax agencies globally to put together an alternative, as there currently is no negotiation platform to propose an alternative? It's a question. Oh, can I bring you and Dr. Khatun on this?
Thank you. Thank you. This is I think I don't know. But what I can say from the point of interest of all countries, you see, across the world, we see many organizations are performing various duties, but in a situation where the interest of smaller countries are also important, and so that their interests are taken into consideration. So I would feel that an organization under the auspices of the United Nations would be something which might work. But again, while creating a platform, also we have to be mindful that quite often these organizations are not necessarily provide what countries deserve, rather how countries negotiate. It is not like in case of many international platforms and international systems, for example, the multilateral trading system, for example, where countries do not get what they deserve, but what they negotiate. This is one of the important predicaments or challenges which this whole multilateral trading system is facing right now. So we may propose another platform, of course, under an international organization or international umbrella, but it would depend how those organizations also perform and what are their governance and regulatory issues which will dictate the terms of those organizations. That's more important. And in order to have, like, connecting my previous answer, is that in order to have something meaningful for countries of the global south, there has to be firstly voice, togetherness, and also a conscious and a more informed strategy. Quite often, the question previously asked that why there is not much, not much high voice together. One important issue is, I think many countries are not also aware of this adequately. What would be the implications of such global decisions? Quite often countries remain oblivious about this. So that's also very important, increasing awareness among the citizens and also the policymakers. That's also very important. Thank you.
Thank you so much.
I just want to say that the demand of the developing countries, for many countries, has been that we need an intergovernmental forum under the auspices of the United Nations. Okay, because the point is, after all, this so-called inclusive framework, which is under the auspices of the OECD and G20, is not an official body in itself. It's just a meeting which is a set of negotiations which are being conducted, but under the auspices of often, well, basically the OECD Secretariat. So the demand was that as opposed to that, what you need is a framework which operates under a framework of discussion which operates under a body in which all countries are equal, which is the United Nations. And that's, and the developed countries opposed that and, had it undertaken under the auspices of, so it's not an OECD thing, it's called an inclusive framework. It's got 139 countries, but it should have been under the UN.
Thank you, Prof. We have a question from Nilachal to Professor Chandrasekhar. Knowing that indirect tax is regressive and resource requirement is huge to address the pandemic for nation states, what is the political economy of the North and South behind bringing this consensus of having the floor for corporate tax?
I think it's a very good question. It's a complex question, but I don't think the fundamental driver of the current phase of this whole global corporate tax regime is the desire of the United States in particular, but of a group of developed countries to bring back into their jurisdictions tax revenues that they think that they had lost to tax havens or to places to which their corporations had shifted the headquarters, or at least created relatively independent subsidiaries which paid taxes in other jurisdictions. So if you look at it from their point of view, it's to try and get more from direct taxation for themselves. But the consequence of that, obviously, is a deal which is going to mean that the ability of developing countries to mobilize significantly from direct taxation is going to go down, and therefore their reliance on indirect taxes, which are regressive, would increase. Though I wouldn't look at it as a political economy where you're pushing developing countries to have indirect taxes, but you're creating an environment in pursuit of your own goals, which results in that. That's the outcome.
Thanks, Professor. Okay, we have a question from Aloysius Kitengo. I hope I've got the pronunciation right. What is the UN Tax Committee position on the minimum tax? How far have we moved towards the establishment of the international tax body? Apart from the poor revenue management, there are several damages, both health-wise and environmentally, caused by MNCs. As it stands, even the 30% corporate tax rate in Uganda cannot address those damages. How will the 15% perform? Can I bring in maybe Chennai, if you'd like to take it, and then if Liddy, you have any inputs on that?
Yeah, I'm happy to pick, I think, some components of it. Yeah, so I think part of this question has been responded to by Prof. How far have we moved towards the establishment of an international tax body? Not far. I mean, at least we saw some progress, right, in the UN FACTI panel report, where they had a very clear recommendation that there needs to be a world tax body, right, that oversees all of these conversations about tax, a space where both developing and developed countries had equal say. Because right now, what's happening at the OECD, I mean, like Prof said, it's only 139 countries that are a part of that, even though, they like to say it's 90% of the global GDP, but I mean, if anything, it's just perpetuating, this notion of, the rich people get to make the rules. So I don't think we've moved far enough, and I think we need to make much more progress. I think with regards to, I mean, it's both the question and an answer. I think the second part, MNCs, you're absolutely right, are often culprits of more than just tax avoidance, tax evasion, right, money laundering, et cetera. There's also some of the social, environmental impacts as well, and those are impacts that we need to factor into, right, when we're trying to figure out how we are going to deal with the effects of MNCs. And so I think, Alois, you're just reiterating, that the 15%, first of all, if countries are not already, if countries, like I said, are in Africa are imposing between 25 and 30, dropping to 15 is going to significantly minimize already what they were making. And based off what you're saying, even that wasn't enough, right? So the 15% will merely exacerbate the situation. Thanks, Sarah.
Thanks, Chennai.
Yeah, well, just to add to this, of course, taxing the multinational corporations isn't the only thing we want to do with them. Well, there's a lot of other measures that we need to think about and resort to. For instance, if there are really massive damages, as they always are in their operations, there has to be some other ways and other forums to address this, by filing suits, by demanding reparations, by getting our governments to enact other legislation and regulation against the operations of these multinational companies. We cannot stop at just simply taxing them, but that's one place to begin. There are many other actions that we must take as citizens groups in order to bring justice to what they have caused in our lives and in our countries.
Thank you so much, Liddy. We have quite a few more questions, but I think because of the paucity of time, I will unfortunately have to move to the next part of the discussion. I'm really sorry. I think I would have also liked to have this session go on for at least another 2 hours, given the panel that we have. But I'll very quickly ask each of the panelists to just give us their closing remarks. And just the last key takeaways from from the discussion today. So we'll start with maybe this time we can start with Chennai. We'll go from the reverse order that we started at the beginning.
Yeah, thanks, Sarah. I mean, I think first of all, it's really affirming, I think, to hear other country experiences, right, and other country views from the global south on this particular issue. And I think I want to pick up the point that someone had raised earlier, that we definitely need to start talking more with one voice, right? Indicating, our concerns with regards to, like I said earlier, decisions that are being taken without our input. But I think for me, I want to end by just highlighting Matty's question, right? So what is the alternative? And I think that's the question we need to think about much more meaningfully, because absolutely we want a UN tax body, but we're not getting that tomorrow. Yet this conversation is happening. In fact, there'll be discussions in October, right? So what would be a much more legitimate forum for us to have this conversation? I think we need to think about that a bit more. But apart from that, Sarah, thanks for inviting us. So we had a similar webinar as TJNA a couple of weeks ago. If you told me, I would have absolutely said you're going to have an extra hour or so to think through this, because right now it is the most topical conversation, I think, within the tax space. So thanks for inviting us, and look forward to any next action steps.
Thanks so much, Chennai. Can we have Liddy?
Yes, just as a final word, I think we have to do a lot more, civil society and movements, in order to bring these issues to people, because sometimes they're not encouraged to take on these issues because there's a lot of discussions that sound very technical and so on. But I think if we bring them the truth and our analysis and our perspectives on this, we really need to mobilize great citizens' pressure and resistance against these proposals, and to take out these issues out of what they call technical experts arenas, and bring this to people at the grassroots level so that we can mobilize people to resist.
Thank you so much, Liddy. Can I bring in Dr. Fahmida Khatun?
Thank you. I would just summarize in 1 or 2 lines what I have said as a point of reiteration, is that a need for awareness building among the broader stakeholders, including the policymakers, including common citizens, experts, and the media, are very crucial in order to create, in order to have an informed voice. That's very important. And also the need for raising the voice at the international platform, proactive participation of countries, that's also very important. And at the same time, the issue of taxation as a whole, taxation governance within the countries is also very important, so that we ourselves have a transparent and accountable tax system, which is progressive, which takes into consideration issues like, tax evasion, tax avoidance, and also the ethics of whole ethics part of it. So that's very important. So I would say that, working at a two-pronged level is very important at the domestic level and also at the global level. Thank you.
Thank you so much, Dr. Khatun. Professor Chandrasekhar?
Yeah, just very briefly, if I can take up where Lady left off, it's at one level, it's quite surprising. You start with the 2008 financial crisis, the complete delegitimization of neoliberalism that it involved, the acceleration of the climate crisis as visible in all these floods and forest fires and, et cetera. And finally, the COVID crisis and the stark realization that the neglect of health has basically completely undermined the ability of countries, even if they can find vaccines, to be able to deal with this health emergency. That you would have thought that this would in some sense bring about change. People thought that, that in some sense circumstances would bring about change of governments as well, in the way they approach things. And what we see is in some sense perhaps the same cynicism here and on many other issues, the same degree of cynicism. You create a mess in Afghanistan and you just walk out of it. You do this on corporate tax, and you do all sorts of things. So in essence, therefore, I think never before has it become clear that to win the social tax sanction, to bring about change, the focus has to shift to citizens' organizations, civil society, democratic fronts, etc. And they are a bit fragmented, and therefore we should also see ways in which they possibly could consolidate, because otherwise things can go completely out of hand. Finally, also, even democracy is in threat for finally. Yep, that's it.
Okay, thank you so much to all our panelists for your insights and your answers. This has been an extremely productive and insightful session, highlighting the intricacies of the deal and also giving us extremely nuanced perspectives that don't often get highlighted, or that, that don't go into this kind of detail. I think each one of you shared a very unique perspective to this issue, and also from different contexts, different countries, and your own different expertise, which I think is very important. I really wish we could have continued on for another hour. So again, I want to thank you all for your valuable comments, your responses, and your time. Thank you so much. I'll now hand over the floor to my colleague, Happy.
So thank you, Sarah. And thank you, everyone. It was an absolute pleasure to listen to all our panelists. We are really thankful to you for, for the insights that you shared with us, and also grateful that you could spare your precious time and enhance our understanding on this topic. I personally have learned so much, from the arguments, the probing questions, and the need to question the deal, and how countries in the global south would be at a disadvantage if it comes through, and what should be the way forward. And I hope so did everyone else. Thanks to each and every one of you in the audience for taking time out and being there. I really hope you enjoyed the discussion and are going back with, some useful points about all the concerns shared here, and, the need in developing countries to promote tax mobilization. All these points which were covered today. I think I must also thank my colleague Sarah for steering the discussion so wonderfully. It was very, very well coordinated, and all my other colleagues also who helped make this meeting successful. So we'll be uploading this discussion on our website, and we also plan to come out in the next few weeks, with a report presenting these insights emerging from this discussion, and we hope to be able to share with you soon. So thank you and goodbye.